Do you invest in stock market? Do you often hear market experts recommend long-term investments to generate wealth? Have you asked yourself how long is long-term? Have you wondered whether staying invested for too long can hurt your returns? If the answer to these questions is yes, then this video is for you. Watch as we analyze Nifty 50 index's performance during last 20 years to find the answers. Nifty 50 has increased 2,283% from 2002 to 2024, meaning, if you had invested 1 lakh rupees in Nifty 50, then it would have grown to become 23,83,000 rupees during this period. But, if you have looked at the chart closely, then you would have noticed something interesting. The performance of the index has varied significantly across years. In fact, there are some years where Nifty 50 has actually decreased. Let's look at another chart to understand this variance in returns. This chart shows the one-year returns of Nifty 50 index from 2001 to 2024. There are 4 instances where Nifty 50 gave negative returns. The biggest of these in absolute terms being the year of 2008, which marked the start of the global financial crisis. There is high variance in returns during the observation period. Even if we exclude the negative values, the minimum returns are 3% and the maximum returns are 76%. The average one-year returns of Nifty 50 index during the observation period are 16.9%. Let's quickly recap what we have established till now. Seeing the growth in Nifty 50 in last 2 decades, it is safe to say that long-term investing is profitable. The magnitude of this growth also shows the wealth creation potential of long-term investing. Now we try to answer a more complex question. Do the benefits of long-term investing diminish as the investment period increases? This graph compares the cumulative returns given by Nifty 50 index for different investment durations. It is evident that 10-year returns exceed 5-year returns during the observation period, except for some outliers. Same holds true when we compare 5-year returns with 1-year returns. Average cumulative returns also confirm this inference. But here's a question for you. Is cumulative return even the correct metric to compare performance to begin with? Comparing returns across different investment durations, using any cumulative metric, will be wrong. Such a metric by design would favor longer duration investments, due to its additive nature. Instead, we will use annualized returns as the evaluation metric to rectify this flaw. Annualized return rate is the interest rate compounded annually. That will give same returns as the cumulative return rate in the same investment duration. For example, if you invest 100 rupees for 5 years and get back 150 rupees, your cumulative return would be 50%. Then your equivalent annualized return rate would be 8.4% per annum, compounded annually. Now let's go back and use this metric to find the answer to our original question. Do benefits of long-term investing diminish as the investment duration increases? This graph compares Nifty 50 index's annualized returns for different investment durations. We can clearly see that the volatility is highest for 1-year returns and lowest for 10-year returns. But we cannot make any clear inference about which investment duration is optimal for an investor. Therefore, we will compare the average and variance of the evaluation metric for different investment durations. Surprisingly, the average annualized returns are highest for investment duration of 1 year and lowest for investment duration of 10 years. This would imply that long-term investing is not as profitable as it is made out to be. Let's see if our inference changes once we bring variance into our analysis. Variance in annualized returns is highest for investment duration of 1 year and lowest for investment duration of 10 years. During the observation period, shorter investment durations have given higher average returns, with higher variance, while longer investment durations have given lower average returns, with lower variance. meaning higher returns have come at the cost of more uncertainty. What then is the answer to our question? Do the benefits of long-term investment diminish as the investment duration increases? Based on our analysis, we have inferred that the risk associated with investment returns decreases as the investment duration increases. Therefore, the optimal investment period cannot be same for all individuals. It will depend on the risk appetite of the investors. A risk-averse investor may choose longer investment duration to ensure lower uncertainty, despite lower average annualized returns. A risk-taking investor, on the other hand, might choose shorter investment duration, despite higher uncertainty, for higher average annualized returns. Brought to you by Finance Weekly. Stay aware, stay invested, like, share and subscribe. For more awesome content, watch our market event explainer and investment basics videos to increase your knowledge.